think we're in a period of just stagnation to some extent where prices move up a little bit, they move down a little bit. I'm a big believer that you're not going to see a crash in prices, but I don't think you're going to see a big run up in prices either.
Hey, what's going on, everybody? It's Chris Naugle back for another episode of the Money School podcast. I'm pumped about today's episode because we're going to get down to the root future of what real estate is going to do. And I've got one of the experts here. I got Jeb Smith coming in from Huntington Beach, California, one of my favorite surf spots out there, and actually just plain out one of my favorite places in California. Jeb, thanks for joining me today.
No, man, Chris, I appreciate you having me on. Pleasure to be here, man.
Awesome. So, let me just get a little background on you. I know we talked offline. You're an East Coast kid, grew up on the beach, grew up surfing a little bit, and you made the migration out west, to California. Like, what was that transition all about? And how did you land in your position as a realtor in kind of leading the space out there in real estate?
Funny story, man. You always look back at your life and just see those small little things that you did and how you ended up where you are. In fact, my wife and I were talking about it a couple of days ago, but went to school in North Carolina. Grew up country boy, rural North Carolina, dated a girl in college that was from Huntington Beach. Her dad was from North Carolina. They moved to California. She went back to school on the East Coast. We met in college, dated a couple of years in college. And during the summer, she would always go home. So during the summer, I would come out and visit Southern California and fell in love with it because, for one, it was 110 degrees with humidity in North Carolina, and it was 70 in Southern California. And I was like, what is this place? Because at that time, I don't think I had gone any further than probably Mississippi, the river kind of being the dividing point there. But nevertheless, when I graduated, we were no longer together. I was a computer science major, so I understand numbers, I understand, calculations, that sort of thing, but didn't really have a direction in which I wanted to go. I didn't want to be a programmer. I didn't want to sit in an office all day, just kind of looking for something different. Her family actually had some connections in the mortgage and real estate business. And so I lived in San Diego for a very small portion of my, 3 months, I believe, in my initial move to California. Couldn't really find a job that I wanted to do. It was almost like I was still in college, still enjoying life, as a bachelor in San Diego, and said, I got to do something career wise, and was able to get a job in the mortgage and real estate industry back in 2002, early 2003 rather. And just kind of fell into it. I mean, there were people, the market at that time was kind of on an upward trend. And people were making money, and I knew I wanted to be in sales, and so I just kind of got thrown into it. I'm a pretty quick learner and asked a lot of questions. And, within a couple of years, I understood the business and was, doing what everybody else was doing, which was either mortgage or real estate at the time.
Yeah. And we're going to get a little bit into your take on real estate, which is very different than I'd say 99.999% of all realtors and brokers out there. But, it's just like any of you that are listening to this, no matter where you're coming in from across the country or the world, like, you should really get to Huntington Beach. I've been going to Huntington Beach for the better part of 20 years. It's always been one of my favorite surf spots, even though the locals are just very territorial by the pier. I just stay a little outside of that. And it's just a really awesome little downtown area. I've watched it just explode. I remember the last time I went there, I'm like, what is this? Like the whole one side, like if I'm looking from the beach out to the city to the right, like none of that was developed when I first started going there. Now it's just like another mini city. So it's really fun and cool to see what's happened, but it's also one of those places in California that is continuing to grow. It's not kind of taking that bad shadow effect of a lot of California. And it's a nice little insulation, and you nailed it, I guess, is the best way to say it with where you chose to be. But let's just dive right in. So real estate, here we are, 2023, we're literally at the end of a cycle. We're at the end of a lot of cycles, the technology cycle, short-term debt cycle, long-term debt cycle, and we are in a period of rising interest rates, which is never really good for real estate. But yet we've got this whole thing, and everybody knows this, of inventory being at all-time lows. After the pandemic, there just hasn't seemed to be enough housing. And it's created a really unique dynamic. You know, when we're trying to look back in time, because I study history like a freaking nerd, you know, we're trying to figure out, like, what is this bubble going to look like? And I look at, you know, I look at 2006 and 2007, and there's so many similarities. I mean, the signs are everywhere. It looks the same. But back then, they had lots of inventory. There was actually probably too much inventory, where today you don't. So let's just start there, because a lot of people, especially folks in real estate, realtors specifically, now these are the ones I was saying, you know, that you're nothing like. They are always eternally optimistic on real estate. They're always like, oh my God, it's going to keep going up. It's going to the moon. This is the time to buy. You can't wait. Go over ask. Sorry, I went a little bit too far there. But you're kind of like, well, here's the things we got to factor. Like, you're looking at it more from a real perspective of where we're at. But what do you actually see happening? I mean, I know prices have weakened in certain parts of California. I don't know if Huntington Beach has, but pricing's coming off of its highs, because mortgage rates are, I think, still right around hovering 7%, which, just so the whole audience knows, that's actually not uncommon. That's actually pretty normal. Yep. But we are so used to this false reality of 2, 3, even 4% interest rates as being the norm, and it's not. So it's not unnormal, but it's unnormal for the current times in this current weird, I don't know, time we're in, I guess is the only way to say it. So where do you see this going based on low inventory, rising interest rates, the Fed playing massive games trying to destroy unemployment? All these things would normally not be good for real estate.
No, I mean, I don't disagree with any of that. You know, I think the only reason we haven't seen bigger declines in prices is like you said, inventory, right? Inventory sitting near historic lows. You know, we thought, you know, I was a big believer 2021, 2022, you weren't going to see those types of numbers again when it came to inventory. And here we are. I mean, I think the Fed, you know, as much as they tried to do the right thing initially by stimulating the economy and, you know, providing bailouts and what have you, they never took into account the long-lasting impacts of taking rates so low, right? So instead of giving every homeowner, you know, a $500 bailout every month for, say, the rest of their life, they decided to take rates from, you know, 4.5% down to 2.5%, 3%, which in turn gave people a lot of opportunity to take money, you know, to refinance and in turn save money. Some people took equity, some people sold, bought other properties, whatever they did. It essentially was a bailout to some extent, and in turn is part of the reason that we're experiencing what we are at the moment, which is inflation and all of the other things, right? I mean, on top of the Fed paying way too much attention, in my opinion, to lagging data on both sides of this, right? And
you would think they would have learned.
Yeah, exactly. And so here we are. You know, it's interesting in the fact that you said you study history, right? I'm also a big proponent of looking at history and what history's done. We don't have this scenario ever, right? We don't have the scenario where 90% of Americans have an interest rate below 5%. We don't have a scenario where inventory is sitting at, you know, close to all-time lows. And, you know, what is the solution, right? I mean, the solution is more property, right? More property will allow prices to come down, to moderate, give people an opportunity. It will create, you know, housing affordability, and if those measures would change. But the reality is they can't build homes fast enough to make up for the lack of supply that we actually have. So that said, I think we're in a period of just stagnation to some extent, where prices move up a little bit, they move down a little bit. I'm a big believer that you're not going to see a crash in prices, but I don't think you're going to see our big run up in prices either, right? I mean, we've got this trend going back historically about 65 years of annual appreciation around 4.6%. right? So what happens is, over a 2-year period, you increase 35, 40, 50% in some markets, you get way above that trend line. So in order to get back to that trend line doesn't mean you have to drop 25, 40% at a time. But I think what has to happen is you've got to have slower growth in that trend, if you will, to get, back to the norm, which in turn allows us to continue kind of going on that upcycle. I do believe personally that real estate will continue to appreciate over our lifetime. I don't think, just because you look at a property today and it's $1 million. I mean, people say, well, there's no way it can be $1.5 million. I say, no, absolutely. It can be $1.5 million. I mean, my wife and I had this conversation. We bought our house for $500,000 back in 2012. And at the time, the joke was, hey, one day this thing's gonna be worth $1 million. Now it's worth like 1.4. And we're going, one day this thing's gonna be $2 million. And it's not gonna probably happen in the same way that the last 10 years happened, but it will happen. So for the foreseeable future, though, I'm just one of those people. It's like, hey, buy when it's the right time in your life, right? Don't try to pick tops and bottoms in markets, and just have a longer term time horizon, right? We know what real estate does long term, creates generational wealth. Reason that homeowners have a 44 times greater net worth than those of renters, and 65% of that is tied up into real estate at retirement. So I'm a firm believer that is the right answer for most people, but it's not always the right time to buy a house. You said all realtors are like, it's always right now is not the best time to buy a house, but if it's the right time in your life and everything else is in place, I'm not one of those people saying, well, you shouldn't buy because this is, there's going to be a better opportunity. I don't know that there's going to be a better opportunity, right? I also don't know that there's not going to be a worse opportunity to buy, right? It's a lot of it depends on the, rates and where inventory goes.
Yeah, I think you said a lot of really good stuff to unpack there. And it's kind of like one thing I'll hone in on is where you said the Fed is always looking at lagging data and lagging indicators. It just seems like, all the people that can make the decisions, they're not looking at the proper data. And it almost seems intentional. Like I know in one of your YouTubes, and just so you all know, Jeb's got a killer YouTube channel. You all need to check it out. It's very good. If you like my content on my YouTube, you'll love his. It's right along the same topic. But, you were talking about, just the unemployment numbers and what the Fed's doing to try to knock the back down of the working, just the employment numbers. I mean, that's what's holding this economy up right now. Some say we're in a recession. Technically we are. Others say we're not. The only thing in the three-legged stool that keeps this thing moving is employment numbers. So of course the Fed's going to try to knock that down. And when people obviously lose jobs or get laid off or go on unemployment, they don't have the disposable income. Right now, you can clearly see what's happening. You can see that savings rates during the pandemic were skyrocketing, and debt amounts were being paid down at unbelievable rates. I still look back at that data and I can't believe how fast debts were coming down. But as soon as the world opened back up, or this country opened back up, it was just a flip. Everybody went on revenge summer, spent all their savings. The credit card debts, I mean, what are we at? 17 trillion right now in consumer debt, something like that, might even be higher. All-time records in consumer debt. So we're trending the wrong way there. If we lose employment, that is going to be the one thing that's going to be interesting. And then you mentioned, just there's really no other period of time that we can look at that mimics what this is. And you're right. We literally have to go to several other periods of time, seam them together, and then just make up what we think it's going to be. But the scariest thing for me is, I think you're right about this stag. The price is just being sideways for a while. And some would say that's stagflation. And we are staring down the barrel of stagflation. And listen, folks, like I can say, like, I'm not scared of a lot of things. I'm scared to death of stagflation. If we couldn't have learned from Japan, when Japan kept interest rates down too long, and then the lost decade after that, the stagflation, like that's what we're looking at right now. And I hope to God we don't see it, but if some changes don't happen, we're going to. But let's just kind of take that same conversation. We were talking primarily about home ownership for families like you, me, our families. There's never really a bad time to buy your home and to bed down and get it. If prices are high, oh well. If prices are low, bonus. Like you bought, when prices were low, but back then it didn't seem like prices were low.
No.
You thought prices were high back then. And look at that, almost $1 million in appreciation. So it's all relative. Interest rates are high right now, but you could always refinance when we go back down. And just so you all know, I'll be the first to break the news if you haven't heard this. Interest rates are going to go back down. We're going to stay at these heightened levels for a little while. And then when we are in a recession, when the Fed gets their way, then the Fed will drop interest rates again. It's just historically what they do. And then you can refinance and do all that, pull your equity out, because I don't think you're going to lose a lot of the equity. So that's a unique proposition right now. If you buy a house now, you're probably going to maintain some of that equity. And then when rates go back down, you can refinance at the lower rate, cash out, pull the equity out, send that money to work. But unfortunately, the people that are going to, I think, really get beat up in this are the real estate investors that just can't see what's coming. And there's a lot of them because we've been in the longest bull run in history. So a lot of these younger real estate investors, whether they're flipping or buying apartment buildings or doing BRRRRs or sub-twos or you name the strategy, all of them think that everything's just going to continue to go up. They've never seen the downside of the market because really, if you think about it, they would have been, I don't know, Jeb, how old would they have been? In their they would have been teenagers about the time when we realized what the other side of this monster looks like. And I know there's a lot of people still flipping houses. And when this thing flips, that's going to be a scary thing for them. So what is your take on real estate investors, not just homeowners, but real estate investors really going out there, pushing forward, scaling, and thinking that this is going to continue?
Well, here's the thing. I mean, buying an investment to flip and that sort of thing is all about the price in which you buy it. Right. So I as an investor, I wouldn't shy away from buying investment property personally, but it's all about the number in which you buy it. The profit's made at where you buy the property, not where you sell it. If you're thinking, hey, I've got to do this, this, and this to maximize my profit, you did it wrong. If you can buy it at the right price, it doesn't really matter what you do to the property. In theory, that value was created in that initial conversation, right? Or initial negotiation with the seller, or however you acquired the property. That said, that's not how most investors buy property in this market. Most investors aren't privy to, hey, buying at the right price. It's, hey, if I can get it here and I can do all of these additional things and the market works out in my favor and I can represent the buyer and all of these things, then I can maximize, a small profit. That's not the right mentality. And I think there's a lot of, like you said, there's a lot of people out there following different strategies, people that are really good at what they do, marketing first, side of things. They're great marketers. And don't get me wrong, they're really good at what they do, but they're marketing to a younger generation to sell courses, to do different things, not pointing to anybody specifically, but those people are the ones that get burned. It's the people that truly don't understand real estate. They just got in it because they wanted to make money and they don't understand the proposition. They don't understand the market. They don't understand how to negotiate. They don't understand that there's several different ways out of, to create value in these, opportunities and different things in each one of these properties. Those are the people that get screwed. So will there be people? Absolutely. Hell, I sold a property. I'm trying to think. It was earlier this year. It was a guy who, if you got time for a story, really quick story, he wanted a cash offer for his property. I went into the deal and I said, hey, bud, you don't need a cash offer. I can sell this on the open market. Yeah, there's some deferred maintenance, but I can get you more money by selling it on the market than I can off the market. He said, no, I want a cash offer. Okay. Said, I'll try to go get you a cash offer. I wasn't willing to pay the price that he wanted for that property. It was too high for repair, aftermarket value, whatever, right? For ARV, if you will. And so I shopped around 3-4 different people, went to one of my prime guys. He was in escrow. After getting into it, he was like, dude, the numbers just don't work. Like, I hate to do this, but I'm out. Like, I got to back out. And I was like, I get it. Right. So it took me a while. Finally found a guy that was willing to pay more than I had initially had my original guy in at. And I'm thinking, I don't know how this guy is going to make money. He bought it, paid cash, did his thing. And here we are. I don't know, 3-4 months later. I haven't seen what that project looks like, but I got to think the market has flattened since then, flattened in the sense that homes really haven't appreciated, but they really haven't gone down either. So his number was probably the number that I was thinking back then. So I don't know what he could have done to that property to in order to come out ahead based on what we thought it was going to be to fix it up. So those types of scenarios, maybe he got out or maybe he gets out and not loses any money, but at the same time, he's probably not making much either. And so I don't think the risk is there. I mean, I think there's too much risk there. The leverage is too high. And I think that what we're talking about right there continues for some time. I mean, there will always be opportunities in every market, but the people that we're talking about here, or that I think we're talking about, are the ones that are going to get, people are going to get hurt. I mean, it's just same people that are not paying their student loans right now and are using that disposable income or that additional income to go do other things. Those people are going to have their life is going to change here really soon when those student loans start to come back into fruition, right? And they have to start paying them.
Couldn't agree more on that. And I think that's the majority of them. They've gotten so used to not paying their college debts and anything that was deferred that they literally don't think they're ever going to have to. So that money that they had that used to be allocated for that is now transitioned somewhere else. And a lot of that money is they can't just pull it back out. So when this all turns around and they have to start paying all these debts, which is, well, for some of them already happening, they're going to find themselves in a tough place. I hope they don't lose their job, get laid off, or do what I think is going to happen to so many people. I hope that doesn't hit them that hard, but it's going to hit everybody hard. But we're definitely going to go into a slowdown. There's no question about that. And it's going to hit all aspects of just about everything, from the stock market to real estate, and it might not even be that it so much affects price in real estate because of the demand, but it's certainly going to impact people when they're trying to get their number for their house and it just sits on the market. They might have to start coming off of that, because the way I always look at it is I'm like, it's supply and demand. Yes, there's not enough inventory, so that's maintaining price. But eventually, we're going to have to come off of these prices if we don't change, what's going on in interest rates, and if people start losing their jobs. Builders are all over this. I mean, builder sentiment's way up. I mean, they like you said, they can't build enough houses, and there's no inventory, so folks are having to go to new builds and do that route. So it's going to be really interesting. I mean, but all of that looks very similar to 2006 and 2007, because the exact same thing was going on there, but there wasn't the shortages. So that's going to just have to play out. You can never time the market, folks, but you can certainly prepare for it a little bit better than a lot of people are right now. So, just pull back on the reins a little bit. Stop spending so much money. Stop racking those credit cards up, playing and extending this revenge summer, thinking that you got to get revenge for the couple of years we couldn't go out and do anything. I live in New York. You guys are in California. It was lockdown central. So a lot of folks are just out there trying to live life. I get it. But at what cost in the future is that going to come with? And let's go. Go ahead.
I mean, that said, I think part of the problem is that the Fed, the government as a whole, has created this idea that anytime anything happens, they're going to be there to backstop it. Right. And honestly, I believe that's the precedent that's been set. And I almost believe it to be, even as somebody that's lived through a couple of different cycles and been in real estate a couple of different cycles, I almost believe that that's truly the case. Times get too hard, the government will step in and bail out, right? I mean, just like they did with forbearance and now, right, there's the idea that with FHA modifications that they're going to change the structure on how the modifications, people that are in not even in forbearance. I mean, there's going to be lasting forbearance with some of these situations, but people that are having a difficult time, that there's going to be an answer for these people. And so you're always giving an out, and that doesn't create the type of generation that we need to, we're sitting at $33 trillion in debt. I read a comment the other day that we're going to have to pay nearly $1 trillion, just a trillion on the interest alone on the debt that we have.
It's doubled.
It's insane. So that alone tells me we can't even afford the interest on our own debt. It's about to pass the national defense budget. It's about to pass Social Security in the next 3 to 5 years if it continues the same trajectory. with all the money they pumped in the economy. So that alone tells me the Fed has to lower rates in order, because the higher rates are, the more interest they're paying on their own debt, which they can't already pay, right? So that leads us into a whole different conversation. But yeah, there's a lot of writing on the wall, so to speak, and the interesting, it's going to be interesting how it all plays out.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
For some of you, if you've followed any of Ray Dalio's videos or his books, that tells the story pretty well, strings it all together. You can see where we're at. I mean, we're right back. We're doing the same thing that the Roman Empire did. They're just spending more money than they can possibly bring in. They can tax more, but that's never going to be a good thing for votes. You're at a stalemate. You got this massive divide in this country, which is probably going to land us in 2024, either into a civil war or who knows what's going to happen. I mean, it's such a divided country that the main focus of both sides seems to just be votes. It's not fixing the problems of this country. It's just how do we get more votes? And to get votes, you got to, at this point, unfortunately, they've set the precedence that they just got to give things away. You got to just give things away to people. And, the people that vote are the people that want something for free. But folks, there is no free lunch. There never has been free lunch. What you get for free has a cost. Oh, we're not going to tax you if you make less than $400,000. Bullshit. You just got the biggest tax increase in your life called inflation. It's a hidden tax. Like, wake up. Like, when they tell you something, you should automatically know it's going to be the opposite. We're not going to tax you. That means bend over. We're going to give it to you where you don't want it. Like, it's what's going to happen. And all of this stuff plays into the end, the end of where all this lies and where all this lands. And that I can't tell you, but from what I see, it does not look good. But I want to keep this. I could go off on a massive tangent there, but I'm trying to pull it back to real estate. I want to hit another thing. Now, I have a lot of experience in real estate, as you do as well, on all facets. Today, I'm mostly just a lender. I don't really do too many real estate deals, nor do I want to. I'm just sort of sitting back waiting, and watching. And some people are like, oh, lazy money, doesn't make money. Well, my money's not lazy. It's always working, but I'm just owning nothing and controlling everything. That's the route I took. But I'm seeing some things that scare the crap out of me. And those things are a lot of these syndication deals. Just yesterday, I got 2 calls from 2 people I know that are raising money for syndications. And they know nothing about real estate. Like, the one guy knows nothing about real estate. He even said to me, he's like, oh, I'm new to this. I don't really know what I'm doing. I know you're an expert in raising money. Like, can you help me? And I said, no. I said, I don't believe in the syndication model. I think there's a lot of hanky-panky in there. I think these guys are rushing out, paying too much for these properties. They're thinking that rents are going to stay at these heightened levels, and they're not factoring in enough downside on all of this. And unfortunately, the person that's going to get hit the hardest are these investors that you're seeking, the limited partners, because the GP more than likely doesn't have anything in the deal, and he's just going to run south like they always do. So what is your overall high-arching take on the whole syndication thing? Because it's definitely gotten big, and the SEC has kind of looked at it and then pulled off of it and looked at it, and they're kind of like, we don't know what to make of this.
Honestly, I mean, if I'm being completely honest, I don't follow a lot of it. I'm aware of what syndication is and how it works. I don't really come across a lot of syndication deals, but I mean, I know now, I mean, there's publicly traded companies out there doing this sort of thing, trying to get multiple people, in, if you will, to invest in real estate and pay a percentage out, and, how these deals work. But, again, buying properties in bulk is, if you can buy properties in bulk, like you could in 2009, 2010, distressed properties in bulk, that's a syndication deal you want to be a part of. Buying properties at market value, and trying to invest in a long-term game of real estate isn't. I don't think that's where the the opportunity lies, in my opinion, right? I think you've got investing in real estate is really about the numbers. It doesn't matter if you're investing in one property or investing in 10 property, whatever, right? So there's, in my opinion, there's two ways to invest in real estate. One is you can invest for appreciation, and the other is you can invest for cash flow. Sometimes you can get both, but I don't think you can go into deals expecting to get both, at least in my opinion, unless you're willing to hold things long term. Yeah. And what I mean by that is, for example, here in Southern California, you can invest for appreciation, right? Long-term California appreciation is about 7.5%. But it's very difficult to get cash flow here in Southern California without putting a massive amount of down payment on a property, in order to make those deals work. Whereas you can go to the Midwest, middle America, if you will, and you can buy property relatively inexpensive where it creates that cash flow. But that said, prior to the pandemic, some of these markets didn't appreciate for 20 years. I mean,
I'm in one of them, Buffalo, New York.
Yeah, it's same prices for 20 years, but you've been able to pay down that asset. You've been able to keep your cash flow coming in. Great. Long-term strategy, it works fine. It just really depends on and you can buy more properties that way and probably leverage yourself a little bit more that way than you can in markets like California. So that model, to me, that works. Buying in a syndication with a bunch of other people where you have no say, you're just a number in the big scheme, and not a decision maker. You have no opportunity to, and a lot of these tie your money up for an extended period of time. And I don't see the reward. I look at those deals and I say, I don't see the opportunity. Now that said, if it's a syndication where you've got somebody that truly knows how to invest in real estate, they're looking to raise money, it's a limited partner situation where there's only a couple of names in it, and there's some sort of, payout and there's experience and that sort of thing. That's something I'd be open to, but I don't think that's the majority of what we're talking about.
That's definitely not the majority of what we're talking about, but I would love to see a couple of those really small ones that are being done proper. But unfortunately, that's just not the majority of what I'm seeing. It's a whole bunch of people fishing in the same pond, and everybody's fighting over who's got the best bait or whatever you want. That's the only analogy I can give it. Let's switch gears here.
Yep.
Let's transition to talk about realtors. It's a space you're really familiar with that maybe I'm not. I see it completely from an outsider standpoint. During the pandemic, real estate went bonkers. People were out of work. A lot of people were laid off, and a lot of people became realtors. It was like a mass flow into the industry of realtors. And yep. Granted, like a lot of them were making money, but now things have gotten really tight. And this has happened before in history, but maybe not to this magnitude. Like, what do you think is going to happen to a lot of these folks that came in and they're part-time realtors and they're trying to go out there? And again, a lot of people fishing in the same pond. Like, what do you think the writing on the wall is for realtors?
I think the gap widens. Pareto principle says what 80% of people do, or 20% of people do 80% of the business, right? I think historically that is not true for real estate. I think it's probably a 5%, 95%, right? 5% of people do 95% of the business. I think the average realtor makes like 30 grand a year or something, right? So it's very, very low. And I'm not looking down on the 30 grand. So don't take that the wrong way.
Well, you can't live in Huntington Beach on 30 grand. You can't live in the worst apartment in the worst part of Huntington Beach in your wildest dreams.
No, you can't. No, not even close. I mean, that wouldn't even pay your rent. But what I'm saying is I think because the market, there's going to be less transactions in the market, a slowing market, slowing demand. Inventory, again, we talked about it earlier, is not going to be any massive increases. There's just going to be less transactions happening. People are locked into their rates, whatever, housing affordability, whatever. People are going to be, I think right now, the average time somebody's in their home is like 11 years, right? It used to be like 7 years. Now it's 11. I think that number probably goes to like 14, 15 years, when they do the next survey, if you will, right? It's going to be an extended period of time because of where rates are. That means less transactions happening in the market. That means less people being able to do deals, which means more realtors moving out of the business. A lot of realtors come in the business because they hear it's an easy game, right? It's real estate. All I have to do is go to my friend. As soon as they want to buy a house, they're going to use me. blah, blah, blah. Guess what? Every person I meet knows a realtor. Every person I meet knows a lender, right? So how do you differentiate yourself? How do you set yourself apart? It's all part of any job. More so in real estate is you got to be the pro. And I think in this market that we're in, that we're going to be in probably for the next 10 years, it's a professionals market. This isn't the market where if you just got your license 6 months ago, you rise to the top. Can you? Sure. Not the majority of people out there. And I think what I see more so than anything else, and I've told this to several people over the last couple of months, is we've created this whole team environment, right? Everybody is a team in real estate. You're this massive team here. You're this massive team here. We've now created these models like EXP, Real, all of these different models where you're a leader managing a team, right? Well, what happens now? Those models are a little bit different. So I'll come back to that in a minute. But what happens to the massive team that has 10, 20 agents on it? They're used to marketing $1 million, $2 million a year for marketing purposes to generate business to feed that team. Well, in a slower environment, guess what? They're still spending $1 million, $2 million to generate that activity. That's now a tenth, maybe a third of what it was, because there's less activity in the market. That means less transactions happening out there. That person at the top has to feed themselves. So they're number one. Everybody else is a byproduct of that. Those people below fall off. There's just less deals happening, less money being made, less transactions happening, less people in the business. So I think there's a lot of teams that are going to go under because they're going to spend more money than they're bringing in. I could be wrong there. On top of that, you got these other models, right? Like the franchise models, the EXPs and all those guys. It's great. But what happens is all the down legs are people that don't do any business. Well, those people are going to be gone. And they're not going to be bringing in any business to the table. The model isn't going to be what it is today, or what it has been over the last couple of months or what have you, years. And, does the model still exist? Maybe. But I think there's an opportunity for that model to have to change because of everything else. These companies are operating on very little margin, right? They're charging their agents very little. And granted, it's virtual, but there's still expenses. And, these guys are publicly traded now. So they're going to have to show a profit and have to do certain things. And with less transactions, more overhead, I don't know. I don't see it being the model that everybody wanted or believes that it's going to be, where they're, just going to get a bunch of agents and they're going to not have to work and they're just going to get paid every month. I see that, being a big problem.
Yeah, I think you're absolutely correct. And that's how I see it. I mean, it's just any one of those models, they have their heyday and then they just disappear. Unfortunately, I mean, if you look at in history, it's not the first rodeo for that, maybe the first rodeo with the virtual side of it, but once this whole slowdown happens, and that you're going to see a lot of changes there. Now, I do want to talk about some things that you do specific, because I know there's some people on here, and folks, I want everybody listening to really look at this next part of the conversation, which is what we'll wrap up on. And I want you to really not just apply this to realtors and brokers, but I want you to apply this to all business. If you really look at Jeb and what he's done, he's invested massively into a brand, into an image, and into free advice, giving value, massive amounts of value. I mean, you look at his YouTube channel. I mean, it's all value. And the only thing he's ever asking you for is to subscribe. That's it. I went on his channel, and like when he asked, I just clicked the subscribe button. And folks, when you watch my YouTube channel, I'd ask the same. If you're watching our value or you're watching our content and you get value out of it, just click the subscribe. That's how we really are shown that we're appreciated. But we were talking offline, Jeb, and we're talking about how much effort it takes to create YouTube content and social media content. And I just think that that's why you're the top. You're at the top, not because you're, and you are probably one of the best at it, but let's just say you're not. But you are out there giving every single day. You're putting new videos up, new content up, and you're doing it without any real reward on the back end. Outside of, yes, some people are like, yeah, it's marketing. He's getting leads from it. Sure he is. But in the beginning, I bet you he didn't. In the beginning, I bet you he put videos up after videos up after videos up and barely got any people watching him. And he just kept going. And that's the long game. But like when we're talking about real estate, making money in real estate is a long play. And making money by being a profession or being the top of a profession is a long game as well. Jeb, if you can just take a couple seconds and, talk specifically about like realtors and brokers on how you've done it, but at what cost it's come at, and maybe just a couple pieces of advice you could give to anybody on how they can rise to the top and what that actually looks like and what it takes.
Yeah, no, I mean, the YouTube channel, I appreciate all you said there, by the way. Very grateful and thankful for people that watch my content and opportunities like this to meet new audiences and, being on here. So that said, my YouTube channel started with the idea to create value, right? I mean, I'm a big Zig Ziglar guy. Zig says, you can have anything you want in life. You just help enough people get what they want, right? So it's creating value, throwing out there. And I also know there's a gap in what people should know when buying real estate and what they actually know when buying real estate. And I'm trying to fill that gap, right? So the value there. And that's where it all came from. Over time, it's progressed. It's become a job. It's become a passion, if you will, because I get a lot of messages from people reaching out, thanking me, hey, Jeb, I'm glad I listened to you in 2020 and 2021 versus the guy that said the market was going to crash. And granted, I've never told those people to buy a house, but I'm just telling you what it is, how to understand the data. You do with it what you want, right? And that's what it's really about. I'm not out here pushing home ownership or telling you to own a home. It's about, hey, listen, this is what's worked for me. This is the way I see things. Listen to people like me, listen to people on the other side of me, and you decide what's right for you, right? But if you're a professional out there, whether you're in real estate, whether you're in mortgage, whether you're a financial planner, whatever it is, and you're trying to create content, or you're just trying to be the top at what you're doing, it's all about consistency, really being consistent day to day, even the days when it sucks, right? Maybe you're hungover, maybe you're sick, maybe you don't feel well. If you committed to doing something, getting up and doing it. Most people fell in YouTube, in influencer, whatever. I hate that word, but because they're not willing to do what it takes every single day when they're not getting the result they want to see. Right. The same thing with owning real estate. People buy real estate and they expect in a year, 2 years for that house to be massively more, and they can now sell it and buy their dream property. It's not real, right? It happened over the last couple of years. That's not real. It did happen, but it's not reality. So take it back. Your home is a place you're going to live. Buy when it's the right time of your life and focus on that. I mean, that's really what it comes down to, whether it's whatever you're trying to do passion wise, or just, put information out there, be consistent, provide value, be yourself. Right. And, that's it.
Man, that was good. That was really good. So folks, right there, it's just, you got to be out there doing the work that everybody else is unwilling to do. Don't get in a circle of other realtors or other brokers or whatever your profession is and just do everything that they're doing. Watch what they're doing and do everything they're not. Do more than what they're doing. Push harder than what they're doing, and you'll rise to the top. But it's not going to happen overnight. It's not going to happen in a week, a month. It could take years. But if you stay committed to what you're doing, you'll always rise to the top. And folks, I urge all of you, with Jeb Smith's page, so it's jebsmith.net. We'll put that in the description. And his YouTube channel, if I'm not mistaken, it's just YouTube/ just Jeb Smith, correct?
Yeah, at Jeb Smith. Yeah.
At Jeb Smith. Yeah. There was a C in there. It was throwing me off. Check out his content. When you're watching his content, you wouldn't even know he's a realtor or broker. Sorry, I always just say realtor, just because that's commonly known.
It's all the same. Yep.
Broker, realtor, same difference. But you wouldn't know it. You'd just think he's giving really good advice that provides a lot of value. But then when you read the first comment of every one of his YouTube channels, you then know, wow, he can actually help me. That's brilliant marketing. Think about that. He's giving value. And then if you actually look at the very first comment on each one, he puts all of his information in there. So then all of a sudden you're like, I just got so much value from this. I'm going to call Jeb. I want to buy my house through Jeb, or I want to sell my house through Jeb, or I want to talk to him. That's how you do it. He's done a remarkable job, and I'm really honored to have had him on this channel. I don't bring many brokers or realtors on. I just don't, because like I said, you are like the 0.0001%. Normally, I just have nothing I can talk to most realtors about, because they're just like, oh, everything's good. Everything's great. You're crazy. The inventory's low. Prices are still going to go to the moon. And I'm just like, okay, this is done. I'm not even going to air this. But I was really excited about this one. So thanks for your time today.
No, I appreciate it, man. I appreciate you being here. Appreciate anybody that listened to this, and look forward to doing it again.
Awesome. Well, folks, for all of you that were listening to this episode, I hope you got something out of this. Even if real estate's not your profession, take some of the things that Jeb has used to rise to the top and apply them in your business. It's not about the knowledge you get on this episode. It's not about the knowledge you get on this channel or for anything you do. It's about how you apply that knowledge day in and day out, consistently and persistently. That's how you move the needle. Folks, I enjoy doing this show for you. I enjoy doing episodes like this. Thank you for your time, your effort, and your energy for being here today. We'll see you next time.